Hi everyone, this is Dimitri Pergamonic with MarketChameleon.com. I wanted to share a screen with you using the naked put spread screener. And sometimes there are traders who like to sell naked puts against a stock that they might want to own, and this way they could collect premium. And if the stock doesn't move or trends higher, then they would just collect that put premium. Of course, if the stock falls below the strike, then they would get put, or they would have to buy the stock at that strike price, and then they would just own the stock, minus obviously the premium that they would have collected for selling the puts. So let's just take a look at a quick screen and see some of the problems that we could address when you're looking to sell naked puts. And right now, the first thing is that the screener is defaulted to the next monthly expiration, but let's just look for the next 30 days. So this is now going to show us all the expirations that expire within the next 30 days. And one of the questions that comes up a lot of times is, well, if I'm going to sell a put, which put should I sell? Should I sell a weekly put, a monthly put, like what duration? Because you have all these different expirations. And then what's the best put to sell? Should I sell an out of the money, an at the money, and in a money put? And that's really hard to say. There's no definite answer. And sometimes we look at historical data to show us as a guide, well, what happened in the past, what tended to work in the past. And what this does is actually run an on-demand analysis for, as long as we have enough historical data, an on-demand analysis for each of these puts based on how far it is away, days to expiration, and how far away the strike is from the stock price. And we do backtest analysis to see the frequency of the wins and the average returns. And then another thing, you might want to compare those results against the benchmark. Well, what if I just owned the stock outright? What would have been better if during the same period I just owned the stock instead of just writing puts on it? So those are the two things that really come up, and that's what we have here. These are on-demand backtests run on those types of scenarios. So let's just take a look first at the filters. And one thing we want to know is, well, we want to see when did selling the put have a higher frequency of wins than just owning the stock during the same time period. So we want our strategy to have a higher win rate than just the stock, just holding the stock. So this is what this is doing, that the win rate of selling the puts on this stock with this many days to expiration and with the stock this far away from the strike price, this was the result. 75% observations. The win rate on the naked puts was 49.3%, whereas just owning stock, it was 33.3%. The next thing we want to filter out is, well, we want to make sure that the naked put strategy did better on average. The returns on average were higher than just owning the stock on average. So that's this. So let's set this, that the strategy average return was higher than the stock return. So now we see we have a higher frequency of wins, and both of them happen to be negative, but this is less negative than just owning the stock for the same period. And when you hit this load, it'll show you the analysis. But let's do a few more scans before we take a look at the analysis here. Now, another thing, since this was a loser, what we want to do is look for strategies that tended to have positive returns on average. So then let's take a look at the average return, and let's just put any positive for now. So now what we did was scan out that on average, the naked put strategy on average had positive returns based on these amount of observations. So we scanned for three things: that the naked put strategy did better than just stock only, that the average returns exceeded the stock returns, and that the average returns were positive. And now it filtered out 1,800 possibilities for us with the expiration and the strike price, and then the backtest results right next to them. Now, these also have a little E next to them, meaning that there's going to be an earnings during this period. So we're expecting earnings prior to this expiration. So let's just take a look at the analysis here. And this is the backtest results. So here are all the individual data points for the backtest, and that's the summary. So between this date, start value, end value, this is what happened to the option, and then this is what happened to the stock. So you could see here the option lost 0.8%, while the stock lost 13.9% in that same period. Here, the option gained 9.4%, while the stock only lost 2%. And then it goes down the line, and here are the averages. This is the option only over here versus the stock only. So you see it did much better here. But then the question is, there's an earnings period. How did the strategy do during only earnings periods, right? So then we could tab over here, and then we see the same type of backtest, except now it's only earnings periods here. So you could see there's a 70% win rate selling this option, this same type, similar option with a 3.4% average return, while owning the stock, it was only, the win rate was 20% with minus 7.2% return. So clearly here, during the 10 observations during earnings, the selling naked put, that was 2.4% out of the money, did better than just owning the stock. So that premium, whatever it was, did better than just owning the stock. So that's how you would pop this open and take a look at these backtest analysis. Really quickly, another thing here, we're just going to go down the line. This is the stock price, market cap. This is the expiration, days to expiration, the strike. This is the bid, current bid of the put. This is the delta. This is how far away the strike is from the stock price. This here is the IV percentile rank of the option. Over here, this is the downside cushion. So how much can the stock fall before you break even if you sell this put? This is the premium, the time premium in the put. This is your return if the stock just stays flat based on the risk. And here we talk about the backtest results. So that's how you could quickly just narrow down your results here. You could also do things like require a minimum of time premium, let's say about 5%. You could do moneyness or by delta if you are looking for deltas above or below a certain amount. So you could do something like that. You could also look for a minimum open interest option price, minimum option price, if the ex-dividend date is before or after expiration, any type of company events before or after expiration, or earnings. So if you want to skip earnings, you could just say the earnings have to be after this expiration, then it'll just narrow down this way. Hope this was helpful, and see you guys in the next video.